Welcome to The Explainer. Today we are diving deep into a situation that has a lot of people scratching their heads. It feels like everything is for sale right now. We're talking stocks, crypto, even gold, and it seems like nothing is safe. So let's get right into the big question. Why are investors dumping everything all at once? I mean, even the assets that are supposed to be your safe harbor in a storm are taken on water. What is really going on here?
All right, and before we really get into the weeds, just our usual quick reminder, this explainer is here to help you make sense of what's happening. Based on our source material, it is absolutely not financial advice.
Okay, first things first, let's just wrap our heads around how widespread this sell-off actually is. It is a sea of red out there, and it stretches from the riskiest assets you can think of all the way to the ones that are supposed to be rock solid. You know, in the riskiest corners of the market, the pain has been really sharp. Assets like Bitcoin have taken a nosedive from their recent highs. This is often the first domino to fall when investors start to get spooked.
But listen, this is not just a crypto story, not by a long shot. The big U.S. stock indices, the bedrock of so many portfolios, are also feeling the pressure. The Nasdaq has seen drops of over 2%, and the S&P 500 is down in a big way too.
And this is where it gets really weird. Even gold, the classic safe haven asset, right, is being sold off, breaking below key price levels. Now, when investors start selling their insurance policy, that is a huge red flag that something much bigger is at play. So, what's the connection here?
Well, the answer isn't that every single one of these assets just became a bad investment overnight. No. The real issue is that investors are desperately scrambling for one thing and one thing only: cold, hard cash.
This quote from our source material just says it all, doesn't it? The money has dried up. There's a severe shortage of available money, what the financial world calls liquidity, circulating in the global system right now.
This whole situation has a name. It's called a liquidity squeeze. And that's not just some fancy jargon. It's a really powerful force that can set off a chain reaction across all markets, dragging everything down with it. And here's how that vicious cycle works. It usually starts with big losses on risky bets made with borrowed money. Those losses trigger what are called margin calls, which are basically urgent demands from brokers for more cash right now. To get that cash, investors have no choice but to start selling, and they'll sell anything they can get their hands on, even their best, safest assets.
So, if the money has dried up, the next logical question is, who turned off the tap? Well, the answer seems to point to two huge players whose actions are putting a major squeeze on the global financial system: the central banks of the U.S. and Japan.
Over in the U.S., the Federal Reserve is sending some really mixed signals. You've got some officials saying, hey, we need to cut interest rates to help the economy, while others are worried about inflation and are saying, whoa, let's hold off. This disagreement is creating massive uncertainty, and if there's one thing markets truly hate, it's uncertainty. Then, at the very same time, you've got the Bank of Japan. Now, for decades, Japan has been the source of cheap, easy money for the rest of the world, thanks to their super low interest rates. But now, they're facing their own inflation problems, and they're starting to signal that they might finally raise rates. Look, a policy change from Japan would be a seismic event for global markets. For years, big investors have borrowed money really cheaply in Japanese yen to go invest it elsewhere. If Japan raises rates, that whole flow of money could suddenly slam into reverse. It would be like turning off a massive global money tap, making this cash crunch we're seeing even worse.
This desperate need for cash creates a pretty predictable pattern of selling. Investors don't just sell things at random. They tend to follow a clear hierarchy, starting with their riskiest stuff and working their way down to their crown jewels.
You can think of it like a selling pyramid. Right at the very top, the most volatile things like crypto get sold first and hardest. When that doesn't raise enough cash, they move down a level to things like tech stocks. But when they get really, truly desperate, they're forced to sell what's at the very bottom, the assets they wanted to keep the most, like gold. So the whole system is starved for cash. Markets are completely on edge, and pretty much everyone is just waiting for some kind of signal, some sign of relief, and all eyes are on one specific date coming up. So here's the date you'll want to watch: December 10th. This is when the U.S. Federal Reserve makes its next big decision on interest rates. This one event could set the tone for the markets for the rest of the year and maybe beyond.
And that brings us to the billion-dollar question, doesn't it? Is the Fed going to ride to the rescue, or will they let the sell-off get even deeper? If they signal a rate cut, that could inject some desperately needed cash back into the system and spark a rally. But if they don't, this painful selling could get a whole lot worse.
And what should we be watching for once the dust finally settles? Well, according to our source, the very assets that were sold last out of pure desperation, like gold, will probably be the first to bounce back, with silver right behind, as investors rush back to what they see as safety.
All of this leaves us with one last big question to think about. In a world that is this desperate for cash, what does a safe asset even mean anymore? Because when there's a true liquidity crisis, it seems like the only genuinely safe asset is cash itself. Thanks for watching.